Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today in episode, I think it's 338, I'm answering your questions. Now, if you're watching the video, you see that I've got a baseball, that's actually a football, but a hat on. And you're wondering what's up, Rob? Like if you take that off, what's going on up there? Well, my wife tells me as I take my hat off that my hair, it's kind of not pretty today. Not that it really ever is. So I'm wearing a cap, which if you're just listening to the podcast, you don't have the video, like what do you care, right? Anyhow, glad to be back with you. I'm going to respond to 3 questions that listeners have sent in over the last couple of weeks. 2, of course, as you might expect, relating to investing. But the first one is actually related to a podcast I did, I don't even remember the number now, on how to learn, how to read, how to remember everything you read, how to try to think better. I'm amazed at, I've been doing a lot of writing for Forbes around the issue of stimulus. What should the next stimulus bill look like? Should there be another round? Should there be a stimulus check? I'm sure most of you probably hope there will be. Should we extend unemployment benefits, and by how much? Should we give money to state and local governments, and if so, how much? All these important questions. And what I find interesting more than quote unquote the answer, because there is no one answer to these questions, is why people believe what they believe. Why do I believe what I believe? You can apply that to anything in life, including investing, like index funds, for example. Do I really have a firm understanding and grasp as to why I believe what I do about index funds and my preference for them over, at least in most cases, actively managed funds? But, there's 1,000 different things. Another example, this whole question about mail-in voting, I confess the whole thing concerns me, not so much from a fraud perspective, although I suppose that's possible. What do I know about elections? But I can see us getting to that election day, and come midnight or whatever, 2 a.m, we're going to have no clue the outcome, potentially, I suppose. And who knows how long after that? I mean, it's possible, right? But when people, view all of the debate over that issue, what I find most interesting is not what someone believes, unless they happen to be an election expert. Then what they believe, I think, can be interesting. Because most of us, certainly I can speak I haven't studied mail-in balloting. I don't know what the risks are. How would I know? It's not how I spend my day. But nevertheless, people have really strong opinions about this stuff. I'm like, wow. I talk to friends and family. You really have a strong opinion about this. Oh, absolutely, I do. Well, you must have spent all kinds of time reading studies and analysis, and no. And I'm like, that in and of itself is interesting. You'll have a strong opinion backed up by what you've read on Twitter. Okay. And so anyway, I went off on that tangent for no good reason. Notice I haven't given you my opinion on mail-in voting, because this is a finance show, not a political show. Let's get back to the topic, though. I did do a podcast on sort of how to learn and how to remember what you read. And I got a question from a good friend, Ace. Haven't talked to Ace in a while. And here's his question. He says, what made you move from Evernote to Devon Think? I just listened to your podcast on the art of learning. You turned me onto the, quote, secret weapon right around the time I was finally starting to use Evernote. I eventually upgraded to OmniFocus, which I am a ninja on now. By the way, if you use OmniFocus, you have to check out the book Creating Flow with OmniFocus by Karash Dini, D-I-N-I. I'm sure I've butchered that name. Ace continues. For several years now, I've read Evernote is going away and Devon Think is the new thing, but I'm hesitant to learn software and import everything from Evernote, and Evernote is still here. Just curious on your reasons, if you have time to explain. And that was the question. So if you missed the previous show, I talked about something called a Zettelkasten, and you can think about it as a system of notes. The notes don't have to be in software. You could put them on index cards or pieces of paper. In fact, the original Zettelkasten, that's exactly how it was created. But the idea is you sort of put one idea in one note. So there's a one-to-one relationship between the note and the idea. But what really makes this Zettelkasten special over time and by time I mean, I think for most of us, years, is that you can link between notes. Now, obviously, that's very easy to do in software, but it's that linking that allows you to connect ideas that might not be obvious. It's that seeing relationships between ideas over time where real learning can take place. And in the podcast, I mentioned Devon Think, which is software. I think you can get a trial version, and then there's a fee. It's not particularly expensive. And I actually love the software. Since that podcast, I've actually moved away from Devon Think. And I'll explain why. I actually got a separate note from a good friend, J.D. Roth, who's the founder of Get Rich Slowly. He and I have been friends for, I guess, more than a decade now. He lives out west, and he had me a bunch of questions. I mentioned the book, How to Read a Book by Mortimer Adler. He has a first edition. It was first published in 1940. He has a first edition copy, which proves he's much more of a geek nerd than I am, although maybe not by much. It's probably neck and neck, but I think with that book, he certainly probably wins the race. And he was asking about another program that I use, which I may have mentioned. It's called Obsidian. So here's the deal on the software, and to answer Ace's question. I really enjoyed Devon Think. By the way, I also have used OmniFocus, and I've read Denny's book, Creating Flow with OmniFocus. I'll get back to that in a minute. I started to grow concerned with applications like Evernote and Devon Think where I don't have control over the data. It's either in a proprietary file format or a proprietary database. And I thought, if I'm going to invest what, could be, as long as I'm on this planet and can still think, decades of time building my Zettelkasten, I'm really reluctant, as much as, by the way, Devon Think I think is a great tool, I'm reluctant to put all of my thoughts in the hands of a proprietary database that might go away. Now, I don't have any reason to believe either Evernote or Devon Think are going away anytime soon, but it gave me a lot of concern. And I looked at ways to export data and back it up, but you really can't export it in a way that I find useful. So I started looking for solutions that allowed me to, one, sort of keep control of the notes themselves rather than sticking them in a proprietary database. And what I found was there were a number of programs where the program itself and your actual data were totally separate. Your notes go in a folder on your computer. In my case, I put it in the Documents folder. I'm on an Apple. It gets automatically backed up by iCloud. And each note is just a text editor file. I use markup, but it can be read by Microsoft Word, Google Docs, and it seems like dozens of editors. I tend to use Ulysses. But that's the point, is the file itself doesn't depend on any one program or software or company. It's very generic. And a program like Obsidian simply says, okay, point me to your Zettelkasten, which is nothing more than a folder on your computer with notes in it, in this case, in a markdown format. And you point it to the folder and it sucks in all of those notes and displays them. I'm actually looking. In fact, let me, for those that happen to be watching the video, I will move. This is Obsidian here. And all my notes you can see are to the left. These are just references to notes in my in the folder on my computer. And these are the questions for today's show that I'm going to be trying to answer. And it's pretty simple. It helps. You can create new notes in Obsidian, and all it does is create a file in the folder you've pointed it to. There are other programs like Obsidian that function the same way, and in fact, I can use them interchangeably. I can Zettel is another one. I can use that, and I have it, and I can just point it to the same folder with all my notes, and it basically does the same thing. But here's the real key: is if these programs go away, I still have all my notes. They still have all of their links back and forth to one another. I can open them and read them with dozens of different programs. So that's what I've ended up doing. I kind of moved away from Evernote a long time ago. I found that I was dumping stuff in Evernote. This is probably more me than Evernote, but I found that I was dumping stuff in Evernote and never going back to it. And yeah. So Ace, hope that helps. Hope you're doing well. And a shout out to your lovely wife as well. And that's question one. All right, the next two, we're going to get to investing. For those of you that don't really care about learning, all right, you can tell I'm sort of in a mood. Not a bad one, by the way, notwithstanding all the craziness in our world. All right, question number two comes from Boone. He says, thanks for your podcast. I've learned a lot over the years. Question, I'm not expecting much out of bonds for the next decade or so. Not that I know anything, which got me to thinking. Broadly speaking, asset allocation has always been set at a stock bond ratio, 60-40, 80-20, etc. Real estate has traditionally been tucked away within the stock portion of an allocation. But should it be? The purpose of diversification is so that there is little correlation between the two classes. Bonds are also seen as a little more stable and predictable relative to the risk reward of stocks. So really they are divergent in both timings of ups and downs, as well as the variance of the year-to-year rate of return, ideally anyway. But should we really consider real estate as a third leg when considering diversification? Real estate probably correlates to the stock market almost as well or poorly as bonds. If the purpose of diversity is to have something that zigs and zags, wouldn't the third direction be beneficial? Let me stop there. I envision the perfect asset allocation that's not well correlated to look like Elaine Bennis dancing. Most of you will know what that means. If your portfolio, if all your classes dance like Fred Astaire and Ginger Rogers, and for you young folks, I guess you're just gonna have to Google who they are, then you're doing something wrong. If your portfolio dances like Elaine Bennis, then you nailed it. All right. By the way, no portfolio really looks that way. You'd like them to, but with sort of globalization, it seems harder and harder to get classes other than extremely different classes like short-term treasuries on one end and emerging markets on another. They all seem to tend to go in more lockstep than they once did. I don't know if that's actually supported by the data. That's just the feeling that I have. Anyway, back to the email. Since real estate is often bought as a mutual fund ETF, I see why it's considered part of the stock allocation. I just think it's divergent enough to be considered its own category, especially now that many real estate categories are down now and bonds don't look as attractive for the next several years. If I were a 25-75 allocation investor, a reasonable allocation might be 10 to 15% of my stock allocation to be in real estate. But what if I change that to 70-15-15 or even 70-10-20? 70 stocks, 10% bonds, 20% real estate. How do you think my returns would look over the long haul? I think this is a good question, but instead of looking up all the historical data myself, I'm going to toss it to you for an answer. After all, that's why they're paying you the big bucks, right? Well, that made me laugh. So I'm not going to look up the data either. Why in the world would I do that? But I can certainly answer your question unburdened by any actual research on the topic. In my own portfolio, I do separate out real estate. It's 10% of my portfolio. But in thinking about my overall allocation, I do include it as part of the stocks. But at some point, that's just a structure as a way to look at the portfolio. At the end of the day, you still have to decide how much you're going to put in what mutual funds, and whether in your mind you separate out real estate like I do as a separate asset class, but still part of the overall stock bond allocation. I'm not sure how much that really matters. Now, one way to think about it, we talk about stocks and bonds, and we think stocks are higher return, higher, I would say risk, but I'd prefer to say higher volatility. The ups and downs swing more because there's other kinds of risk, right? And some would even argue that volatility isn't a risk. That's what a Warren Buffett would say. He said, no, volatility isn't a risk. Not knowing what you're doing, that's a risk. But losing money, that's a risk, but volatility, not a risk. But in any event, stocks, high expected returns, higher volatility. Bonds, lower expected returns, but lower volatility. Well, yes, that's how we think about it. And I think when we talk about stock bond allocation, that's what we're looking at. But the truth of the matter is, it's not quite that simple. I can show you bond funds that are incredibly volatile, right? Emerging market debt, some super high yield junk bond funds. I mean, they almost behave more like stocks. And it's possible you could find stock mutual funds that don't have as much volatility as the market. Maybe older companies, utilities kind of thing. So we kind of use stock and bond as sort of an abbreviated way of saying high return, high risk or volatility, low return, low volatility. And that's fine for sort of everyday discussions and even on this podcast. But if you look under the hood, as you should for your own portfolio, you could have stocks that aren't that volatile and you could have bonds that have crazy volatility. So where does real estate fit into this? Well, for those watching on the video, and I'll describe it for you guys that are listening, I pulled up on Morningstar the Vanguard 500 Index Fund and obviously a stock mutual fund and the Vanguard Real Estate Index Investor VGSIX, which is a REIT. And the first thing I wanted to look at was performance. Frankly, I was kind of surprised by this. If you look at the S&P 500, the 10-year performance, and this basically mirrors the market. As we know, Vanguard, there's the fees on this are just a couple of basis points. The 10-year return, 13.84. Now, as I thought about it, that made sense. I mean, obviously, the stock market's been on a tear. But compared to the REIT, 10 years, only 8.5%. So a big difference. And if you look at 15 years, stocks return 9%. Now, we're going back right into the 07, 08 time period, so that's why it would be lower. But, real estate hasn't done much better, or it went down as well, 6.44%. So over the last 15 years, stocks have actually been a drag on, real estate has been a drag on a portfolio. It's a short-term thing. I mean, 15 years may not seem like a short-term thing, but I think big picture it kind of is. Obviously, real estate went through a very difficult time for a number of years. In the last financial crisis, it's going to go through difficult times now. Certainly the commercial space has to, right? Residential seems to be on fire right now with low interest rates. We all know this is going to change. We don't know when. Powell came out and said he's going to keep low interest rates. I think he said till 2023 at least. I just think they heard I predicted rates would go up in 2010, and they're just rubbing my nose in it. I think that's the only reason he did that. It's probably not for any economic policy. But in any event, so real estate has not performed as well as stocks, at least stocks as measured by the S&P 500 over the last 10 to 15 years. And even more recently, like year to date, the REIT is down over 10%, while the S&P 500 is up over 5%. What does all this mean? Well, that was just returns. Still, the returns for REITs have been long-term pretty good. They haven't beaten the S&P 500. But I'm not sure that's very meaningful because, as we all know, the S&P 500 has just gone up by crazy amounts, and that won't last forever. What's interesting is when you look at risk, and by risk, again, I mean volatility and specifically standard deviation, which I'm highlighting now in the video. If you're watching, standard deviation is a fairly easy concept. If you imagine, we'll use stocks you can calculate standard deviation for anything, any sort of average, but for returns, say the average return is 10%, and let's assume standard deviation is 10. What that means is you could take the standard deviation and add it and subtract it to the average return. So if the average return is 10, you add a standard deviation of 10, that gets you to 20. You subtract a standard deviation from the average, that gets you to 0. So you have this range, 0 to 20. That would be considered one standard deviation from the mean. By the way, I'm going back to both college and law school. I took statistics in both. So for you math majors, if I get this wrong, I'm pretty sure I haven't. But if I did, you can email me. So you've got one standard deviation away from the mean. And that's basically what that means is 2/3 of the time, I think that's the right number, the actual return of that investment in any given year will fall within one standard deviation of the mean, from 0 to 20 in my hypothetical. And then you can go out 2 standard deviations. So you'd add another 10. So you'd go from 20 to 30 and you'd subtract another 10. You'd go from 0 to minus 10. So you've obviously got a larger range, and that encompasses, what is 2 standard deviations? I want to say 95%. 95%. At least that's what Google says. See, I kind of remember something. So 95% of the time in our hypothetical, in a given year, the return is going to be somewhere between minus 10 and 30. I kind of chuckle because it's like, well, goodness, Rob, I mean, that's a pretty broad range. Yeah, I know. You can go 3 standard deviations. So back to our Vanguard 500, standard deviation is 17 and a half. So just one standard deviation off the mean, the average return, I'm just going to call it 10%. I know it's been higher than that, just to make the math easy. Well, that takes you to 27 going up and minus 7, right, on the downside. That's a huge range, and that's just 2/3 of the time. You have to go 2 standard deviations to get 95% of the time, which shows you just how volatile stocks are, right? So I've kind of walked through the math, if you will, just to prove what we already know. Now the question is, well, what's the standard deviation of a REIT? You want to guess? I know, you're on the edge of your chairs. You can't wait for the answer. It's exciting, I know. Well, it turns out for this REIT, it's the same, a little higher actually, 17.95. So when I think about asset allocation, I like having different asset classes because as I rebalance over time, I'm buying low and I'm selling high, or I'm selling my winners, if you will, at least to get back down to my allocation, and buying the losers, if you will, the ones that aren't performing as well. And over time, I think that will serve me pretty well. What I don't want to do, though, is buy an investment that has a crappy return just for the sake of saying I'm more diversified. So that's why I don't buy gold. People want to say, well, you need to be diversified. Buy gold. I mean, yeah, I want to be diversified, but gold has low return long term and can have really bad volatility. It's like, well, I don't know, why would I don't want that kind of diversity. I could, same thing with Bitcoin. But if I can find an asset class like REITs, like emerging markets, that over time have high expected returns, I'm fine with the volatility. Because again, if REITs take off next year and the S&P 500 goes down, I'm going to be rebalancing. I'm going to be taking advantage of, yes, a volatile asset class, but one that in that hypothetical is going up. I can rebalance, and it gives my overall portfolio, I think, here's the thing, it actually gives your overall portfolio less volatility as you have these different asset classes. But of course, that requires you to rebalance. And it also requires that these two asset classes, or any other asset class that you would introduce into your portfolio, are not highly correlated, right? If the S&P 500 and REITs go up and down in lockstep, you might as well just not have them both. What's the point? Again, finding asset classes that have high expected returns that aren't highly correlated can get difficult, but that's one of the reasons I also have 10% in emerging markets. Some I have same in small cap, some do small cap value. And so that's why I do it. Now, I think the big question that Boone asks is, do I think this will help my long-term return? Probably not. I think it might help volatility a little bit, but do I think my overall wealth will be more because instead of putting, let's just make up numbers, instead of putting 70% in stocks, I put 60% in stocks and 10% in REITs? No, probably not. Certainly, there's no way to know, of course, and there's no reason for me to expect that I'll have a higher return. But I like the if I can have a similar return and added diversity, to me, that's a win. And that's the reason I do it. I do it more for the diversity than an expectation that I'm going to make more money. Yeah, so that's it. That's my thinking. Hope that helps. Maybe I made it worse. Maybe you're more confused. By the way, before I go to question 3, I want to jump back to Ace's question because I forgot to mention, I mentioned it and said I'd get back to it. This book, Creating Flow with OmniFocus. OmniFocus is sort of a task management program, and it's a fairly sophisticated one, just like Devon Think is a fairly sophisticated program. And I read the book by Mr. Denny, and I've actually emailed him. I think it's a great book. At the end of the day, I just found I was spending too much time on the tool, the software. So I just use Things, which is much simpler and just meets my needs. I actually was kind of into OmniFocus until I read his book. And it's like, the book was great. It's just that it underscored for me that I don't really want to spend my time learning and using a sophisticated piece of software like that for that purpose. You, by the way, can use OmniFocus in a very simplified way. But I didn't feel need to. Things is a very easy program to use, and it helps me remember to change the battery in the smoke detector. So that's what I use. All right. Question 3 from, I'm going to mispronounce it, Rash McCant. Sorry, I know that's bad. Ever since I came across your podcast starting from DR 179, when I was looking for an asset allocation tool, I really like your honest and down-to-earth approach and advice. My question is that you normally talk about your allocation about 70-30 while you're in your 50s. I am retiring in a month. I have achieved financial freedom, I think, but don't know where to settle for the allocation ratio. I and my wife both have almost similar total financial assets, but when you talk about it, do you consider your wife's finances and talk as a total asset allocation, or is it individual and talk about the total family asset and family asset allocation? So I think he's asking, do you look at the entire pot of gold that you and your spouse or significant other have accumulated, or do you say, no, you're on your own, you figure out your own thing and I'll do my own thing? He might not have meant it quite that harshly. He continues, I can take moderate risk and I really like your 4% rule, sequence of risk, new bucket strategy, or bucket within asset allocation. Can you advise, here's the question, the second question, can you advise what would be an ideal asset allocation for me? 70, retiring in early October, wife still working for a few more years and not yet eligible for Medicare, good company, so on. He also, I won't read this part of the question, but he also asked me about long-term care insurance. All right, so that's his question. Let me start with a comment that may seem out of left field about backtesting. When you look at asset allocation, whether it's for someone about to retire or when you're just starting out, you'll come across a lot of portfolios that people are promoting that say, this is the portfolio, and the reason this is the way to go is we've backtested it. And we've backtested it over, you pick some very long period of time, 50 years, 70 years. And this is the one that does the best. It comes up, by the way, in retirement because, as the question mentions, the 4% rule, many folks have looked at different asset allocations in retirement and said, okay, we've analyzed all these asset allocations, back-tested them. We've looked at all of the different ways you can decide how much to spend each year. And trust me, they get far more complicated than just a set percentage of your investments adjusted for inflation. And we've looked at all those different possibilities, and here we back-tested it, and here's the winner. This is what you should do. So one thought I've had recently is how little I actually trust back testing, which may seem odd. It's like, well, we all know that there's no guarantee that history will repeat itself, but what else do we have? I mean, we can't predict the future, so isn't it the best thing that we have? In some ways, yes, but here's what I've come to believe. Again, it's not backed up by data yet, but it makes sense to me. And it's this, the more specific the investment, and I'll tell you what I mean by that in a minute, the less you can or should rely on historical performance. So what do I mean by that? Well, one approach to investing would be to say, you know what, let's forget all this asset allocation stuff. Let's just go back 70 years and pick the investment that's done the best. And if it's, I don't know, it could be Philip Morris, actually, which I know they're not Philip Morris anymore. At one point, they were the best. And the reason they were the best, by the way, and I don't remember the time period, is because they were getting hammered by lawsuits. So their stock was getting crushed, but they were just a cash generating machine. So they were buying back stock and paying dividends that were getting reinvested. And over a long period of time, man, you'd have made a fortune. I'm sure that's not the number one investment if you go back, 50 years. But we could do it. We could dive into history and figure it out. How confident would we be that, okay, so we're going to put our money in that one investment? Well, of course, people, we wouldn't even need data or analysis. That's ridiculous, Rob. I mean, it may have done the best over the last 50 years, or pick your time frame, but the odds of it doing that well or better than all the other investments over the next 50 years, who knows? And in fact, whatever did the best over the last 50 years, well, it may not even still be in business. I don't know what the answer is, or it could be, on the downslope. So, not looking so good. Obviously a silly idea. Well, does the idea get much better if we pick a very narrow asset class? I don't know, small cap value, micro cap value. Well, that's certainly bigger than one company, but it's nowhere near mirroring the market, right? Or maybe emerging markets. I mean, my hunch is it'd be an asset class like that, if we wanted to go to the asset class level, that has probably done the best. So are we comfortable putting all our money in that, asset class that frankly would probably involve, depending on which one you picked, hundreds, if not thousands of companies? It's not like investing just in one company. But even then, we'd probably get squeamish. It's like, it's just too much uncertainty. I don't know. Yeah, it performed a certain way over the last X number of years, but I'm just not comfortable putting all my eggs in that basket going forward. And so, we get into an asset allocation mix where we say we're going to have 10% in small cap value, this in emerging markets, this in REITs. We've got it fine tuned. We're going to have 7.24% in that asset class. And look, it did so well over the last 50 years. It's like, but I wouldn't be so sure about the future. And so, and some folks might look at that and say, Rob, I'm now more uncertain about what to do than ever. My approach to that is that, look, at high levels, and we'll talk about it, asset allocation matters. What I mean by that is this. There's a big difference between, say, a 70-30 allocation, stocks to bonds, and a 30-70 allocation. That's going to matter a lot. That could be life-changing, depending on which way you go. 75 versus 25, or 75-25 versus 70-30, probably not going to matter a lot. As with the earlier question, do you include REITs in a certain way, or do you separate them out and maybe get a little greater exposure to REITs? Probably not going to matter. Do you invest in small cap value or just small cap? Or do you do a total market? It's probably not going to matter. And there is really no way we can know now if it will over your specific investing time horizon, time period. Yes, I know what history tells us. And if someone wants to follow that, and to some extent I do, I just don't do it dogmatically. But if someone chose to, I don't think it's a bad decision. I just don't think it's the only good or right decision. Now, of course, that raises the question, well, then how do you decide? Well, and this gets to the question 3. Let me answer the easy question first, and then I'll answer the hard one. In terms of our family investments, I manage them all. I give my wife updates. She doesn't usually want to hear them, but I tell her how market was down 3% today. Here's how much we lost. Don't tell me. That's what she says. Okay. But it's all one pot. I mean, we do asset allocation across everything. Well, in our taxable accounts, they're all joint accounts. Obviously, retirement accounts cannot be joint accounts, so they're separate. So she has her IRAs, I have mine, and so on. But from an asset allocation perspective, we keep them together. Now, I could see a situation where you wouldn't do that. If there's a significant age difference, right? If someone who's 75 is married to someone who's 50, yeah, you might want to have separate asset allocations, or at least to some extent, or at least somehow factor in the age differences, right? But that's just not a reality that I have to deal with. So we're roughly the same age. And so we treat it all together. That's how we do it. Now, as to can I tell you what your ideal asset allocation is? I absolutely cannot do that for a whole host of reasons. But one of which is there'd probably be a dozen different questions I would want to know. How much debt do you have? What are your goals? What other sources of retirement income do you have? And the list goes on and on. I can tell you, though, how I think about it for me, and maybe it'll be helpful to you. The first it has to do with the 4% rule. I will not follow the 4% rule in retirement. And what I mean by that is, I think the odds of me wanting to spend exactly 4% of our net worth or our investments in year one of retirement are slim to none. And I can't imagine I'll want to spend exactly that amount adjusted for inflation each year until I'm dead. It's just not going to happen. Hopefully I'm spending maybe a little less than that. I guess it depends on how things go. But the reality is I'll probably spend more early in retirement and less later in retirement. That's what studies show people do. As you get older, you tend not to take those around the world trips as frequently. You tend not to spend as much money. And also, I think in bad years meaning the market's down, or if we ever hit high inflation again, I'm probably going to cut back, even if I think I don't have to, just out of being conservative. So I don't see myself as sort of blindly following the 4% rule. I'll probably, I think one of two things will happen. I'll either spend significantly less than 4%, which is my hunch, or if I start to spend something close to 4%, I'll put, and I've talked about this in previous shows, guardrails on it. So that, I might spend 4%, even 5%, but I'm never going to take, let's say, more than 6%. So if the market's down and what I want to spend would require me to go over 6%, I'm not going to do that. So I'll have some kind of dynamic spending rules in place if my spending approaches or even exceeds 4%. But here's the thing I know, that all of the different studies on how much you can spend in retirement, dating all the way back to William Bingen's 1994 article, that from which came what we know of today as the 4% rule, is that they all assume an asset allocation. Well, two assumptions really that are important. One is an allocation that favors stocks. He assumes basically 50 to 75% in stocks. I think he probably favors something closer to 75, could be 65. But if you go well above that, say to 100, bad things can happen. You go well below 50 and you've got too much in bonds, bad things can happen. So that's the first parameter, somewhere in the 50 to 75. The second is they all use total return. And none of the studies that I've read, and I've read many of them, do they focus on some sort of dividend-focused income investing approach to a portfolio. They're looking at total returns. And I've talked about this. I think I like dividends, but this idea that a dividend is somehow free money, or that it's better in retirement to live off dividends, I just don't think it's true. Particularly if it pushes you into an approach to investing that lowers your total returns. Because all of these studies that say 4% or something close to it, your return really matters. And yes, there are bad years, but there are good years. And if your overall average return is significantly lower than the market because you've been focusing on REITs and utilities and other, master limited partnerships and other investments that might generate more income but have a lower total return, you could be in trouble. No different, by the way, than if you're paying someone between advisor fees and mutual fund fees, 1 or 2%. None of the studies factor in fees. So bear that in mind. So those are sort of my first two parameters. I want to be somewhere between 50 and 75, roughly. I certainly would never go below 50. I think I'm a little bit above 75 right now. That's just because the market's been crazy. And I'm going to focus on total return. And then what I look at is how much do I have in bonds in terms of years of expenses. So if I had to live on my investments and the market was terrible, how long could I live on my bonds? And if I'm at 10 or 15 or 20 years, I'm very comfortable, very, very comfortable with that allocation, regardless of where the allocation comes out. It's just, that's how I sleep at night, is I have those in bonds. Now, I've talked about the bucket approach. I think it can be doable. I'm not going to, I've concluded I won't use it. Right now, I'm not spending our investments. When it comes time in retirement to spend, once a year, I'm just going to take out what I need and rebalance. So, and it almost won't matter which asset class I take it from. Because once I rebalance, which I'll do all at the same time, it doesn't matter. I can take it all from stocks, rebalance. The numbers are going to turn out to be the same regardless of which fund I take the year's worth of spending money from. Now, what will matter, of course, is which account I take it from a tax perspective. That's a different issue. But so that's kind of how I think about investing as you're nearing and going into retirement. I don't think there's one right asset allocation. As I said, I do think there's some wrong ones. I think there's a range of rightness. But again, I don't have a pension to rely on. Some people might. That could change the equation. At the moment, I have income, so I'm actually not spending the money. So I guess there's that. We don't qualify for Social Security yet. Eventually we will. That could change the equation and how I feel about it, but those are several years off. And we'll probably wait till we're 70 is my hunch. And kind of use Social Security as almost longevity insurance in case we happen to live to be whatever, 150. Can you imagine that? I can't think of anything more awful than that. Anyway, so I hope that's helpful, but that's how I think about it. I can't give you your ideal asset allocation. Heck, I don't even know that I could tell you what my ideal asset allocation is. I can just tell you what I'm doing. My basic allocation hasn't changed. Again, it's gone up. I'm probably close to 80-20, probably down now a little bit. That's just because I own a lot of Apple and they just exploded. Now they've come back down in recent days, but that investment, it was a small percentage of my portfolio at one point. Now it's like, I don't know, 10% or more. More than 10%, closer to 15. So, which was not what I expected, but I guess it's a good problem to have. So that's sort of increased my overall asset allocation in terms of stocks, but I'm okay with that, So yeah, there is really no one ideal, but I think those parameters are how I think about it. Hopefully you'll find it helpful. So there you go. Hey, listen, I hope you guys are surviving the craziness okay. COVID-19, hope you're staying safe and healthy. And keep sending in your questions. Better to send them to rob@robburger.com because the dough roller email for me has kind of just been overrun with spam. So I'm not really even checking it now. So rob@robburger.com. Would love to hear from you. Join the Facebook group, doughroller.net/Facebook group. And until next time, remember, the best thing money can buy is financial freedom.